people are looking to the central banks create another 5 years of expansion or something, and the central banks are saying, hey, wait a minute, don't put all that weight on us. So then people are going, well, then the national governments have to step in and start spending more money, so-called fiscal stimulus, right? And so this is like where these ideas like universal basic income or modern monetary theory, which says the government can spend as much money as it wants, because people are realizing maybe the era in which central banks could push the economy forward is ending. And that may be why precious metals and treasury bonds are becoming extremely popular now, as people are feeling uneasy about this whole idea, that central banks can push the economy forward, even though it's already long in tooth.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information.
Welcome to the Silver Doctors interview. Today, I'm excited to have first-time guest, Mr. Charles Smith, creator of the of2minds.com website. He's an author as well as a blogger, a commentator. And so, Charles, I'm excited to have you on the show. So welcome to Silver Doctors.
Thank you very much, Mike. It's my pleasure to be on the program.
Well, I appreciate you taking time to sit down with us. And so you're a very prolific writer, so you're constantly writing. So I stay in tune with your work as well as our viewers. And so it's interesting to have you now one-on-one and to get your take on things and to get your thoughts about where things are heading. And so before we dive too deep, I'm curious to find out, what are some things that really has Charles Smith concerned at this current time, end of summer, early fall, in this time frame of 2019?
Great question, Mike, and I appreciate that. I did a post last week, and I called up a chart of the S&P 500, a chart of silver, and a chart of the long bond, right? The 30-year, 20 and 30-year treasury bond. And all these charts are looking really strange. They're looking like very unusual. Like we all know and are delighted to see silver just explode from 14 to 19 and a half, right? It's fallen off a little bit. That's normal. But then the treasury yield has just collapsed from, almost 3 a few months ago to like 2, the 30-year treasury. Those are signs of panic, right? Of tremendous unease where people are chasing these safe, risk-off assets, right? And then you look at the chart of the S&P 500, and you see this weird period of these wild swings all the way through August. With every other day, there's another gap up, a gap down. It's like, this is not a healthy market. That's what I see.
All right, understandable. Now, so let's talk right about the equities markets. And so it looks like, according to this trade war situation and also our president's Twitter situation, also fluctuates those equity markets. And so some days it's up, some days it's down. What's the underlying problems that we're experiencing when it comes to equities? Is it the trade war? Is it more than that, or what?
A great question, Mike. And certainly we all see the trade wars in every headline and every tweet. And let's talk a little bit about that, because that impacts us in a lot of different ways. We mostly are told, oh, well, because the price of TVs and smartphones and stuff that come out of China are going to go up, and that's a bad thing for American consumers. But you look at the way that the Chinese and the Russian governments are buying gold and these kinds of things, it feels like there's like tectonic changes, like the plates of the global economy are changing. And there's a lot of opinions about the US and China. Some people say, well, China's ascendant, it's the new superpower, US is fading, and this is the result of the trade war. But I don't think it's quite that simple. I don't think it's, one side's winning, one side's losing. It's like a readjustment, right? Because the Chinese have been very dependent on the dollar. I mean, they peg their currency to the dollar. So, they're not going to be free of the dollar till they float their own currency. And then they're also very dependent on the U.S. Consumer for a lot of their manufacturing. And so, and it's been good for U.S. companies, right? Why have corporate profits soared in America? Well, they offshored all the manufacturing to China because the wages there are like, a fifth of U.S. wages. So the U.S. companies have reaped a huge gain. And I was just looking at, before we started recording, I thought we might get into the trade deal, and I just was doing some research, and like how much of the money that China gets for making an iPhone, right? And on the books, the iPhone value is put on the trade books at like $250 each, right? That's the wholesale value coming out of China. But when people look into it, they discover that the Chinese, in terms of the Chinese companies and the workers, they only get $10 of that. Because all the parts are what cost money, and they're coming from South Korea and Taiwan and the US and Europe. And so very little of the expensive components are made in China. So the Chinese are getting a credit, like they're shipping a product worth $250, but they're only getting to keep $10 of it. So there's a lot of complexities in this trade thing, that it's not all as simple as we think, is kind of my point. And so this period of readjustment is going to be iffy, right? Because everybody's going to, and the Chinese have a right to try to cut the best deal they can. The US has the same right. So it's going to be, push and pull. So I don't see any instant resolution. I'd say it's months away.
Months away. And so that's interesting that you put it that way, because as of now, as this thing unravels, a part of that volatility of the markets is that whenever a meeting, the next meeting is scheduled, markets go up, and then if they fall apart, markets go down. And so if it's going to take months of some type of situation to be ironed out, in your opinion, that means we're in for a much probably greater ride of volatility, and especially when it comes to the equities market?
I think you just nailed it, Mike. I think it wouldn't surprise me at all to see 10, 20% moves, similar to what we had last year, right? In late 2018, hit a new record, and then the whole thing kind of falls apart in a few months, and then it's saved by the Federal Reserve and so on. But it's interesting too, Mike, because it's tying into the US election, right? There's a lot of people out there saying, hey, the Chinese are playing a long game. They're just going to wait for Donald Trump to lose the election in 2020. And then they'll have a free ride with the Democratic the president-elect, whomever that might be, will probably go easier on him, right? And you go, well, that makes sense. Heck yeah, But the Chinese are also, their economy's under pressure, right? I mean, it's a slowing down, not just because of the U.S. trade war, but just globally, right? I mean, they're dependent on the global economy, and they've been pumping a tremendous amount of money into their economy. Apparently about $40 trillion in the last decade. That's a lot of dough, right? I mean, the Federal Reserve pumped in $3 trillion. That's a lot of money, but the Chinese have added a zero to that.
Right.
So that's created a lot of imbalances in their economy that, regardless, even if they solve their trade war, they got debt, and default issues.
Wow. So you mentioned debt, and so you hinted at Federal Reserve, twice in your statement there. So let's talk about the Federal Reserve. And so we have a president that's very he's not ashamed to express his opinion on Jerome Powell being behind, and we should have been cutting rates, never should have raised, all that stuff like that. And so this is the month where I believe they're anticipating a cut of some kind. What type of cut should we expect? And then will there be some type of official easing that begins as far as stimulus or quantitative easing or whatever they might be called this next go round?
Yeah, that's a great topic. And it's on everybody's minds, right? Because the stock market is so heavily dependent on what central banks are doing, right? And so we have to kind of go back in time, in my view. Like, let's start back at 10 years ago. In 2009, the Federal Reserve acts super aggressively, cuts interest rates to zero, starts buying bonds and mortgages in the trillions. And this was, at the time, Ben Bernanke said, this is like unprecedented. This is an emergency measure. We got to save the economy and all that stuff. Well, it worked, right? To the degree that we've had 10 years of kind of tepid, not so great expansion, but expansion nonetheless, right? So they've succeeded at that. But now they started back then with interest rates were about 5.5%, so they had 5 percentage points, what we call 500 basis points, right? If you divide it into hundreds, you had 5 interest points to drop, right? That would make a big difference to auto buyers, home buyers, mortgage rates would fall a lot. Well, now we only got 2 points, right? The Fed funds rate's like 2.25 or something like that right now. So there's just a lot less leeway, are people going to go out and buy a house that's already pretty pricey in a lot of the US if interest rates drop a 0.25% or a half, probably that's not going to be a deal breaker, deal maker, right? It's just not enough, right? So that's where I don't think they've got the leverage they did back then, And so the other thing we have to remember is, people assume the Federal Reserve actually sets the interest rate. They don't. They set the Fed funds rate the lending rate between banks. The actual, treasury yield and the mortgage rates and all this kind of stuff, they're set by supply and demand. So if people are, around the world are jumping in buying U.S. treasuries and there's huge demand, then the yields will drop, right? But if their demand dries up, the yields go up no matter what the Fed does. So we have to remember the market has a say here. And because the treasury is so liquid, in other words, you can always buy and sell hundreds of millions of bucks worth of treasuries. It's a popular market globally, right? So it's not just exposure to U.S. investors and mutual funds and so on. It's like a global thing. So if the world, makes a decision about the U.S. dollar or the U.S. economy or the treasuries, that's going to impact our mortgage rates and everything else.
Right. So borrowing costs, it looks like it will be problematic in the days ahead because of, would you say it's been an overextension of monetary policy intervention? And so in your opinion, it took unprecedented monetary policy to, keep an expansion going a little bit, probably longer than it should have. Now, will the world be dependent upon monetary policy to try to make right their wrongs?
That's an excellent summary of the dilemma, Mike, because as you say, people are looking to the central banks to save, create another 5 years of expansion or something. And the central banks are saying, hey, wait a minute, don't put all that weight on us. We've already done our job for 10 years. We don't have enough left to guarantee that, right? We can do a little bit more, but there's not much more that we can do. And so then people are going, well, then the national governments have to step in and start spending more money, so-called fiscal stimulus, right? And so this is like where these ideas like universal basic income, like giving every adult or every household $1,000 a month. Presidential candidate Andrew Yang's idea he's gotten some popularized that idea, or a modern monetary theory, which says the government can spend as much money as it wants because it can always print more. So you start seeing these ideas coming out because people are realizing maybe the era in which central banks could push the economy forward is ending. And that may be why precious metals and treasury bonds are becoming extremely popular now, as people are feeling uneasy about this whole idea, that central banks can push the economy forward, even though it's already long in tooth.
Now, a part of the debt situation, because there's, I guess, 17 trillion negative yielding bonds. And so it looks like there will be an increase in negative yielding bonds, which will probably force a lot of people into treasuries, as well as the strength of the dollar increasing. How will this play out in the months and years ahead? Will the dollar be able to continue to strengthen without it really impacting American businesses as well as consumers here?
That's a terrific topic, Mike, and I think that's really the topic we should be focusing on, because regardless of President Trump's beliefs on interest rates and the strength of the dollar, it's history tells us that countries with strong currencies are wealthy because they can buy whatever they want from around the world with their money, right? But if your currency is declining in value, you're not getting wealthier. And so, everyone says, oh, well, U.S. exports, it will be hurt, and it's all like, well, frankly, the dollar's been strengthening for a while. So U.S. exports are expensive compared to, developing world countries. So I don't think anything's going to change in terms of if the dollar strengthens more. But you also bring up a topic of what's going to happen as people start seeking a yield. They don't want to just actually cost them money to own a German bond or a Swiss bond or a Danish bond. They want an actual yield. Well, then the U.S. Treasuries is still attractive. I mean, hey, 2% is better than zero, right? So all that money is going into the dollar for another reason, which you are an expert, I think, in the movement of the dollar and the dynamics around currency trading. Is when people are looking around at these other nations and other blocks that are, struggling, right? Like Europe's kind of in recession already. Japan's kind of stagnating. China's got problems. Where are you going to put your money where you might gain appreciation by owning a currency? Well, the dollar is looking like a pretty good bet. In other words, if you buy a treasury bond and you're switching from euros or yuan or some other currency into the dollar to own that treasury, if the dollar goes up 5%, you've made 5% plus the 2% yield. You've made 7% in a world. That's a great trade if you're, having to manage 100 billion or, serious money. So I think, as you kind of implied, it's very likely that the dollar will strengthen in the years ahead if the rest of the world is going into recession at a faster rate or a deeper recession than the U.S.
Now, my next question as a follow-up to that would be, since you mentioned recession, so there's so many nations already around the planet that's already having pretty severe economic woes, and their currency, being reflected in that. And so do you think this next slowdown, and first question is, are we in an economic slowdown officially, i.e. recession? And then will this officially start from the outside, or will it start from within our country when it becomes mainstream news?
It's another great question, Mike, because typically if we look back in history, we often find there's some kind of external shock, as you imply. Like 1973, it was oil quadrupling, from the situation at that point in time, and then you had oil going up to 140 or whatever it hit in a barrel in 2008, which helped kick that recession off. And then you had the subprime mortgage meltdown in 2008 and 9. So these were like external shocks. And so when you look around the U.S. economy right now, you don't really see anything quite like that. You don't see a Lehman Brothers blowing up. You don't see any one sector in tremendous distress. Although I think a lot of people in the Midwest would say the farming sector is in tremendous distress, right? There's a lot of defaults. Commodity prices are just been beaten to historic lows. It's very tough in the farming states. But beyond that, so maybe we're going to have a different kind of recession. Maybe we're going to have one that's just what I call a debt exhaustion. It's kind of like, it's not like there's any crisis. It's just that people go, I've kind of decided I need to start saving money instead of borrowing it, Right. And it's and maybe now's not the time to try to buy a bigger house or get another car, that kind of thing. And so it may be we just have that kind of stagnation slowdown because people kind of get the feeling, like when we're talking about precious metals being in demand, and people are starting to feel nervous or hesitant, and so they're going to start saving money, and that will cause a mild recession as opposed to a crisis kind.
Now, as people start to feel the pinch based upon the economic environment and decide to save more, saving doesn't really go very well in a nation where 70% of our production comes from consumption. And so do you think that might actually end up accelerating things where the Fed has to then interact, because they're looking for inflation, and apparently no matter where they look for, they can't find inflation. So how will saving, really, how long will that last?
Yeah, that's a very good topic right there. And so, many of you have probably heard about this thing called the Chapwood Index, where these guys, they take a basket of prices of consumer goods, and they do it within each city, and they compare it in the past. And, so they're looking at price increases in particular cities, not just across the whole US. Now, those guys have found price increases of like 7, 8, 9% annually. So it's like the Fed's looking, and they must be looking for like the white rabbit or something, because the rest of us know that inflation is at least running at 4 or 5 or 6%, right?
Yeah.
And then the other thing, of course, is asset prices have inflation's gone up in assets, and it's horrific to me because I live part-time in California and part-time in Hawaii, and I look at a house used to cost $200,000. It was actually affordable to 2 regular, working people. Now it's like $1 million or $900,000. It's like only affordable to doctors and lawyers and, techie millionaires. This is not a healthy thing, And so when you talk about people feeling nervous, it's partly because assets have gotten so overvalued. They're no longer a good deal. In fact, precious metals, why people are going to precious metals, it's pretty clear they're undervalued, right? If you look back at, they've gone down for 8 years, stocks have gone up for 10 years, housing's gone crazy for, 5 or 6 years. So this uncertainty, saving money is still a good idea because it gives you some, some leeway if something does happen in your household, like your hours are cut, or somebody doesn't get a bonus or that kind of thing. And so that could happen, right? And the Fed, I'll try to be brief here, but you bring up like, well, then the Fed's going to be pressured to lower interest rates to zero. My concern is, what if nothing happens? What if that doesn't work? Like, what if it's just not enough anymore? Then people will lose faith in the whole idea the central bank can always save us and can always push stocks higher and always push housing higher. And if people lose that belief, then you could really get a downward spiral.
Yeah, I do agree. Now, if they drop rates to zero, and so they're basically they're going to be reacting and responding to pressures from externally, starting to come home to roost a little bit. Now, one of the issues would be, cash. If people start to feel a pinch and realize they're being charged now to park their savings or investments in general in a financial institution and start withdrawing, can we run into some type of problems where we might have a banking situation?
Well, that's a very good topic too, Mike. And you go, well, what happens? How do banks make money, right? Well, they make money in two ways. One, they rip us off with late fees and monthly fees and fees for this and fees for that. And they make billions of dollars, right? And so off of that, those rip-off fees. And but they also make money by loaning money, right? And so if people kind of cut back on credit card purchases, buying cars, buying houses, well, then the bank's earnings are going to go down. And everybody says, oh, the U.S. banking system is healthy. And it's all like, well, I don't know if, who do you trust in that, but just the fact that their profits will take a hit will have a big impact, because financials tend to lead the whole stock market. When financial companies are doing well, the whole stock market goes up. When financial companies are suffering and their profits are declining, then the whole market tends to follow that.
Right. Now, Charles, as we draw towards the end of our discussion, I'm curious to get your future projections. And so you do a great job of writing content that really gets people to thinking. So I know you have you probably thought about this before. Looking ahead, the next decade, we're approaching 2020. And one of my concerns is that because of monetary policy, 2020 through 2030 will probably be years that we could have never imagined as things start to unravel when it comes to currencies, just the cost of living here in America. What are some things that you probably, some worst case scenarios of things that might unfold?
Well, again, I keep saying those are great topics, but they are, because these are important topics to, what we want, of course, is you prepare for the worst and hope for the best, right? So we're not talking about, well, we hope this happens. We hope it doesn't happen, but we have to prepare for things that could happen, right? And so my kind of big picture idea is, look at the system we have, what we call capitalism, and it's a version of capitalism that's global, it's industrial, it uses a huge amount of energy, and it's all based on debt, right? It's all about credit and finance, right? And that's why the global system the global amount of debt has gone up from 100 trillion like a few years ago to 250 trillion now. And that's like, hey, 10 trillion here, 10 trillion there, pretty soon you're talking real money, right? I mean, these are enormous quantities of debt that have to be paid back somehow or not paid back. And when they're not paid back and then they default, then somebody has to eat that loss. And what happens is we have to remember, every debt is somebody else's asset. So that student loan, well, that's some mutual fund owns that, right? That's their asset. That's their income. So when the student defaults on that student loan, the mutual fund has to write that off, and they lose the income and the capital. And that's true of mortgages, auto loans, you name it, right? Sovereign bonds. So we have a debt problem globally, and that's probably going to come to a crisis, as you say, within the next 5 years, no longer than 10. And the other thing is, capitalism is based on the idea that capital earns a return. Right? I mean, you save up money in the old ways, and then you put your money to work and you get a return. And it's related to risk and return. The higher the risk you're willing to take, the higher the return you might get, right? Well, now with negative, yield bonds, like you're saying, becoming, the standard, it's like, well, wait a minute, capital doesn't earn a return? Well, the system's broken. In other words, if capital can't earn a return, then what happens is all that capital is pushed into casinos, right? Basically wild gambles, in the stock market or housing or derivatives. And so it's like, well, for those of us, what about us, just regular individuals? And it's like, I don't know if I want to play in a casino because I might lose, right? Really, the only people who can win in these casinos are insiders, right? Or if you've had 20 years of trading experience and you're really, on top of a market, you might pull it off. But the rest of us, it's like, well, we're more looking for some kind of safety. We don't want to gamble. So again, the precious metals are on the rise after 8 years of decline. And why? I think people sense that they need to get something that's not going to go to zero, when they wake up the next morning, or that it won't go down 40% overnight. And if you're playing around with debt or assets that are based on debt, hey, when somebody defaults, yeah, your bond does lose 80% of its value right then and there, and there's not a thing you can do about it. So that's kind of like what I see as a debt crisis, where the wealth is destroyed either from hyperinflation, like Venezuela has suffered, or from huge defaults that just crush, dominoes. Everybody starts defaulting, and there's no way the system can recover from that.
As you mentioned, precious metals, gold, silver, sound money. And so as more people begin to catch wind of it, I hear that there's more people institution-wise creeping into the space in the form of, digits and ETFs and things of that nature, not necessarily physical. And so I'm not sure if you follow the trading, mechanisms or whatnot, but will there come a time where there may not be enough metals for institutions to get a hold of, or perhaps it trickle down to your small coin dealer shops where it becomes so precious that it's hard to, source some, as well as, will people be willing to get rid of it in a worst case scenario, like you kind of painted when capitalism comes to an end or halt?
Right. And speaking of capitalism, I think what's going to happen is it has to reset, right? Lots of times systems reset, like it's just not working, it's broken, and so it has to be reset. And so we need to get back to a situation in capitalism, and as a general system where it's not constantly, markets aren't manipulated by central banks and governments, where we have some kind of sound money that you can count on, that the government can't just print trillions whenever they feel like it and give it to their buddies. So that's the reset will be healthy. In other words, we're not talking about this doom and gloom lasting for the rest of our lives. It's like the reset will be, very uncomfortable and disruptive, but it's all going to be for the better, is what I'm saying. In terms of silver and gold shortages, we've seen these things where where there's a panic buying kind of at the end of the cycle, where suddenly everybody that said they don't own any gold or silver, and then they start looking at it, and then suddenly they decide to buy it, right? And then that's when that it gets into this kind of tulip bubble mania, and you go, well, how high can the prices go? And well, silver went to 50 without really breathing hard, last time. Gold, there's all kinds of possibilities. 3,000 an ounce, 4,500 an ounce. It all depends on, as you say, the panic. When the herd panics and turns, then you get these crazy price increases. And so, obviously, the strategy is get some before the herd turns.
All right. Very true. Well, Charles Hugh Smith, it's been great having you join us today. Ken, for those that may not know how to find you or be familiar with your work, can you direct them on how they can be a blessing to you, as well as keep in tune with what you have going on?
Yeah, please visit me at of2minds.com. There's free chapters of my books, and all my archives are free.
Sounds good. Well, once again, Charles, look forward to continue to follow your work as always, and definitely have you on in the months ahead as things unwind, and hopefully get your thoughts and take it at that point. So once again, thanks for joining us here.
Thank you so much, Mike. I really appreciate the conversation.